Hello everyone, my name is Oliver from Lux Trading and today we're talking about liquidity providers. Why are liquidity providers important for prop traders? The Forex market is the most liquid world's trading platform, as the community considers money as an asset with absolute liquidity. The Forex daily trading volumes are close to $7 trillion. That is why traders may sell and buy their assets instantly. On the other hand, the success of market players highly depends on liquidity providers. So what are their roles and working principles? Let's find out. Who are liquidity providers? A little dive into their responsibilities. Let's clear up the notion of a Forex liquidity provider from the viewpoint of a broker. The market is comprised of over 3,000 brokerage firms. This is why the market is extremely competitive. All brokers need to provide their traders with the best possible conditions, including executing their trades instantly. When a broker doesn't work with liquidity providers, the order book only contains asks and bids placed by the registered traders from that broker. So sometimes the book may not be filled up with orders. So if we take a look at who liquidity providers are, they are companies who connect brokers with the top banks, hedge funds, and other major participants. Eventually, what this does, it fills up the order books with asks and bids from lots of different sources. So the traders are able to execute their orders instantly, as there's always enough asks and bids. What is the difference between market makers and liquidity providers? Sometimes people exchange the words liquidity providers and market makers. These two notions are very close, but you need to understand the differences. Market makers are amongst the most mysterious characters in the Forex market. This category may include both major players or brokers themselves. When a broker leverages no liquidity provider services, the brokerage works as a market maker itself. It connects traders offering bid and ask orders. In the Forex market, we call this a B-book model. The A-book model implies liquidity providers are mediators between brokers and major players like banks, hedge funds. Those institutions are then the market makers and connect the ask and bid orders. Why is the highest liquidity important for brokers? There are a few big pros to having a high liquidity pool if you are a broker. For one, spreads moving to zero. When the liquidity is low, the differences between bid and ask prices can differ, creating spread gap where traders make their losses. So it is always beneficial for a broker to have a high liquidity so he's able to have the tightest spreads possible. And number two is reducing slippage. As slippage occurs when there's not enough bids and asks to fulfill the order and market price, that means the traders have to get their orders executed either above or below the price that they asked for. Why is it important for traders to get their orders filled by liquidity providers and not market makers? It is always best to trade by a broker or a prop firm that doesn't trade against you. As trading is already difficult enough, you don't want the company to who you give your deposit or a fee set the trading rules and conditions in their own favor. This way it would be a lot more difficult for the trader to make good results. The best decision is always to choose a prop firm and a broker that doesn't benefit from your loss, that only benefits from your gains. This type of broker or a prop firm will always work with well-known liquidity providers like well-known banks such as Barclays, Credit Suisse, or Goldman Sachs. The reason why it is always better to have your orders filled by a liquidity provider and not a market maker is so that you can be sure that whatever amount you earn in the market, you actually get paid. As with a prop firm that trades against you, you're always relying on the prop firm having collected enough fees to be able to pay you out. There is always a chance that too many good traders make a profit in a market movement and the proprietary firm doesn't have enough fees collected to pay out all the winners. We've seen this happen even to well-established prop trading firms. The chance that this will happen with one of the well-known big established banks is ridiculously smaller then that'll happen with a prop trading firm that is trading against you. So make sure to always choose a prop trading firm and a broker that have quality, well-known liquidity providers. We here at Lux Trading Firm work with a well-known and reputable broker, Global Prime. They don't trade against our prop traders. They can prove to you that your orders are getting filled by liquidity providers such as Barclays, Credit Suisse, or Goldman Sachs. We here at Lux want to be as transparent and open with you as possible, so that you can be sure that we don't trade against you, and we and our broker are in the game with you. Therefore, we've asked our broker for a written letter confirming that this is in fact true, and we want to advise every single trader to ask for some kind of proof before you hop in and pay your fee to a proprietary trading firm that might be trading against you, and using the fees as liquidity to pay out the winners. If you have any more questions about liquidity providers, feel free to post them in the comments. And if you want to ask anything else, feel free to reach out to our 24/7 live chat or send us an email at info@luxtradingfirm.com. I wish you a successful day trading and have a great one.